Welcome to another episode of Antipodes Magnified, our quarterly deep dive into the markets and the Antipodes global portfolios. Volatility made a dramatic comeback in 2025, with global equities down around 2% in Aussie dollar terms in the first quarter, led by a 5% decline in US equities, while Europe and China outperformed. Even though the events of the first quarter have been eclipsed by Trump tariffs, the broadening in the market is a meaningful break from the trend. And the Antipodes Global Value portfolio generated 7.8% alpha and the Global Long Short 10% alpha. We think this trend can persist, driven by regional fiscal shifts and sector and style shifts driven by an infrastructure-led investment cycle and recent developments in AI. Joining me to discuss these developments is Portfolio Manager Rameez Sadikot. Welcome, Rameez.
Thanks, Alison.
Rameez, let's start by discussing those regional shifts observed in the first quarter. What's your take on how you think this can unfold?
I think what we're seeing is that Trump's aggressive trade policy and defense policy, it's really galvanizing China and Europe to spend more. And it's almost, it insulates them, it shields them from effectively the volatility of US policy. And Germany is a good example. I mean, recently they passed an amendment to their basic law. And, it represents a significant departure from what historically has been a very conservative fiscal stance. And that amendment has allowed them to pass a fiscal package, which includes a 500 billion euro infrastructure investment fund. And they've also, very importantly, they've lifted their debt brake. And that means that they can increase their defense spending. So the European Commission, the Rearm Europe proposal, I mean, that's going to increase European defense spending to about 3% of GDP, which is similar to or the same as the US. And, what we think is that can probably add about 2% per annum to Germany's GDP growth alone. Now, remains to be seen whether that will actually get spent.
Yeah.
But the important thing here is there's been a material shift in attitudes. And that's what's gotten the market excited. So that's kind of what's driven their outperformance in Europe over the last quarter, and particularly in the cyclical parts of the market. Now, China's a little bit of a different story because we don't have the same, definitive fiscal stance that we're seeing from Europe. But we think the direction of travel is pretty clear. And Trump's trade policy, it's going to be painful. But, that pain can be mitigated by, offset, at least partially, by, the fiscal position of Europe and China. But I think, we have to contextualize what we're seeing today amongst the broader cycle. I mean, the US has come from a position of, a period of very loose fiscal policy, strong economic growth, expensive multiples, and they're moving towards a stance of fiscal tightening, yes. Right? They can't continue to expand the deficit at the same rate that they had been without consequence. Whereas if we look at Europe and China, where we're coming from a period of relative fiscal tightness, weak economic growth, cheap valuations, and then moving towards a pathway of fiscal loosening.
Okay, so it sounds like those regional shifts can persist. And what about the outperformance of China? You mentioned that the rhetoric around stimulus is getting louder. And we've also had the arrival of DeepSeek, which really weighed on the performance of US mega-cap tech stocks during the quarter, didn't it?
Yeah, it did. I mean, the Magnificent Seven as a group, they probably, I think it was 16%, a decline in US dollar terms over the quarter. And that was a very volatile journey. Yeah. And really the instigator of that was DeepSeek. DeepSeek is a large language model that has been developed at relative low cost by the Chinese, much lower cost than the existing players. And I mean, DeepSeek in itself is not so important. It represents probably one of many evolutions that are going to take place in this AI arms race. There will be another DeepSeek in coming quarters or years, but it's what it represents. And in the first instance, it's gotten investors to question what are the returns going to look like on the billions that have been plowed into AI infrastructure. But also, importantly, we think there's probably two things that we need to think about. Like the first thing it signals is that the Chinese are actually not that far behind the US. I mean, they've been able to develop a fairly competitive large language model at much lower costs without access to the leading edge hardware. The second thing that, and I think, probably the more important thing is that it's signaling that the cost of AI is falling.
Yes.
And when the cost of AI falls, adoption will increase. And what that means for us as investors is that value will shift. I mean, value is going to shift from the hardware layer to the application layer. It's going to shift from the enablers of AI to the adopters of AI. And that means that there's going to be new winners. And so what we're doing in the portfolios is we're looking across sectors for businesses that can benefit from this, businesses that are cloud native, where data is an asset, right? So they have data that is broad, that is deep, that is organized, that companies that are positioned to harness that and apply AI to either reduce their costs or improve their productivity or enhance the value proposition to their customers. And importantly, we want to find those businesses where that earning stream isn't priced. Really, I guess the broader message here, though, is, what does it mean for US mega caps? And we think that, it's definitely indicative that the exceptionalism in US mega caps is beginning to wane.
Yes.
And with that will come a broadening of sector preferences.
Yeah, okay. Great segue into discussing the performance of the global portfolios over the last quarter. No surprise then that the key performance drivers were our overweight to European financials, industrials and commodities, our overweight to Chinese internet and software, and our underweight to US hardware and software. Yeah. Two of the standout performers over the quarter were French bank SocGen and also French-listed defence business Thales. Can you elaborate on those positions?
So SocGen doubled their fourth quarter earnings. That was primarily driven by their a rebound in their French retail business, as well as a strong investment banking operations. They also announced a larger than expected buyback, and that was amounted to about 900 million euros. And they've indicated going forward that there's going to be more as they return value to shareholders and they strive to, I guess, close the discount between the share price and tangible book value. We really like SocGen. I mean, it's one of our top 10 holdings. We think that the NIMs, their interest margins, can continue to expand, even despite the fact that we're in an environment where the ECB is cutting rates. And that's because they have a fixed price mortgage business that's going to reprice higher at the same time as their deposit costs falling. The bank's got a really strong capital position and it's trading on 5 times FY27 earnings. With respect to Thales, I mean, it is Europe's largest defense electronics firm, and we really think it's in a great position to capitalize from the broader backdrop whereby Europe is going to increase their defense spending in response to US policy.
And in terms of our exposure to Chinese internet and software, King D International Software, particularly in the long-short strategy, and then Alibaba in long-only, were also key alpha drivers over the quarter, weren't they?
Yeah, they were. King D, they're a large enterprise resource planning software provider. They've been increasing their market share in China as they benefit from domestic substitution. We're really excited about the Chinese AI and the Chinese AI cycle, and we think that King D is in a really, really good position to be able to integrate AI into its platform.
Yes.
And they'll be able to monetize it. And Baba, we all traditionally know as an e-commerce business, but it's actually one of the largest cloud vendors in China as well. And now, as AI costs fall and adoption rise, so too we think will the growth in Baba's cloud platform, the growth and profitability in their cloud platform. We see Baba, we think that it can probably compound at about 20% per annum. The other thing that's we need to just note is that Baba is actually making some really some strong inroads into the development of large language models. QN is the one that they're developing. We've trimmed these names over the quarter. They've been very, very strong outperformers, and we just have thought it prudent to lock in some of that alpha.
And Barrick Gold, another key performer over the quarter. The global portfolios are overweight gold, and that is anchored by Barrick.
Yep.
And look, the gold price has had a very, very solid run over the recent period. So how are you thinking about gold exposure in the portfolio?
We think it makes sense to own gold, especially against a backdrop of heightened economic and political uncertainty. We like gold. I mean, gold is, we think, something that can do well in a hard landing environment or a soft landing environment. It's underpinned by, quite an enormous amount of central bank buying of gold as they diversify away from US dollar reserves. And that trend's been continuing for the last few years. But in an environment where growth begins to disappoint and real rates fall, we think that there's a lot of potential for the retail investor to step in after 3 years of retail outflows. The retail investor, more recently, as real rates have fallen, we have seen a pickup in retail flows. But those flows are still well below where they had been historically. And then Barrick Gold, is one of the largest stocks in our portfolio. It's also well capitalized, well positioned to capitalize on the increase in price, especially as they increase production. And Barrick's trading on 10 times earnings or just below 10 times earnings and 0.5 times net asset value.
And to round out those performance drivers, the underweight to US hardware and software was also an alpha contributor. So not owning Nvidia, Apple and Tesla generated around 200 basis points alpha over the quarter. Rameez, given the degree of policy uncertainty, what portfolio changes have been made?
Yeah, probably as the volatility starts to pick up around middle of February, we began to trim a lot of our long winners and we tilt the portfolio to be more defensive. Now, the trims really centered around our cyclical exposures, particularly the ones in Europe that have performed very well. So SocGen, Airbus, also Siemens Energy.
Yeah.
Siemens Energy has more than doubled in the last 6 months, and more recently it's been participating in the rally in European utilities associated with increased load growth as a function of AI. Now, we trimmed these positions, we like these positions, and some of them are the beneficiaries of longer term structural investment thematics. We thought it prudent, just given that we had such a strong period of outperformance in a short period of time.
Yes.
From the perspective of risk management to pare back those exposures. We also trimmed some of our crowded positions. So I mentioned the Chinese names earlier, the Chinese software names, but also Oracle. Oracle's been re-rating for some time now, and we've been trimming into that strength.
And how has that capital been deployed?
Well, we're tilting the portfolio to be more defensive. So some examples of that: European utilities. In the US, we've purchased HCA Healthcare.
Yes.
This is the largest healthcare operator in the US. It trades on 13 times. It's growing mid-teens. And it has a 40% return on capital employed. In China, we're looking for beneficiaries, high quality consumer names that are likely to be beneficiaries of Chinese stimulus, but also have not participated in the big kind of AI correct. So an example of that is China Resources Beer. Another name is Amazon. So, Amazon has the forward multiple is compressed quite a lot. It's derated. And the reasons for that is concern around tariffs, concerns around the retail growth, and also AI investment. And, we think that the retail business looks okay. They continue to gain market share. And, the cloud business right now is priced at a discount to its peers. Amazon, we kind of see as being somewhat agnostic to the winner of the AI arms race, a little bit like the arms dealer of AI, and we think actually better placed to navigate the uncertainty. And on top of all of that, we have, the recent price action gives us an even greater margin of safety to compensate for what is a wider range of outcomes. If our conviction around the US growth shock or global growth shock actually increases, we will lean more into those defensive names. But, we're trying not to get too bearish just yet. China and Europe, they are stimulating.
Yeah.
The Fed could always inject more liquidity into the market and come to the rescue. We're not quite sure how things will play out in terms of Trump's deregulation agenda.
Yes.
The extra revenues from tariffs could be distributed, could fund further deeper tax cuts. There's a lot of uncertainty still, so it's important that we would not be too bearish.
Sure. So fair to say leaning defensive, but ready to respond to changes in the macro backdrop. Rameez, if we can focus on the long-short strategy just for a moment, the shorts generated around 200 basis points of alpha in the first quarter. Given the extreme volatility that we're seeing, how are you thinking about the short book?
Well, given the uncertainty in markets, it's prudent that investors think about tail risk protection to protect against the unexpected. In the global long-short strategy, we use a combination of levers, so single stock shorts, index shorts, credit protection, and we're really aiming to be nimble here. The volatility, we expect it to persist. And, we're going to be quite active in recycling capital from our single name shorts as they work into other tail risk hedges.
Thanks, Rameez. That's a great overview of the key events of the quarter.
Thank you.
And remember to tune into the next episode of the Antipodes Good Value podcast, where Rameez and I discuss Trump's tariff policy, what it could mean for the US economy, and the relative winners and losers.